Gold has long been considered a symbol of wealth and prosperity. It has been used as a medium of exchange, a store of value, and a standard of currency for thousands of years. Its inherent value and rarity make it an attractive asset for banks and other investors. But why do banks specifically buy gold? One reason is diversification. Banks, like any other investor, want to spread out their risk and protect themselves from economic downturns in any one particular area. Gold is a stable asset that tends to hold its value well, even in times of economic uncertainty. It is not subject to the same risks as other assets, such as stocks or bonds, which can be influenced by market forces or government policies. By including gold in their investment portfolios, banks can diversify their holdings and reduce the overall risk to their financial stability. Another reason banks might buy gold is as a hedge against inflation. Inflation is when the cost of goods and services increases over time, resulting in a decrease in the purchasing power of money. Gold, on the other hand, tends to increase in value during times of inflation, making it a good way for banks to protect the value of their assets. Gold has a long history of maintaining its value, even during times of economic turmoil, and it is often seen as a safe haven asset during such periods. Now, there are a few different factors that can influence the relationship between gold and inflation. One of the main drivers of inflation is the supply and demand of money in an economy. When the supply of money increases faster than the demand for goods and services, it can lead to higher prices and inflation. Gold, on the other hand, is a finite resource and its supply cannot be increased at will. This helps to maintain its value and makes it a good hedge against inflation. Another factor that can impact the relationship between gold and inflation is the level of uncertainty in the economy. In times of uncertainty, investors may turn to gold as a safe haven asset, which can drive up its price. This increased demand for gold can also act as a hedge against inflation, as it can help to maintain the value of an investor's assets. Finally, banks might also buy gold as a way to maintain the value of their foreign currency reserves. Many countries hold reserves of foreign currencies, such as the US dollar, as a way to stabilize their own currency and support international trade. But if the value of the foreign currency declines, it can affect the value of the country's own currency. By holding gold in their reserves, banks can help to protect the value of their foreign currency and maintain stability in the financial system. Gold is a globally recognized asset, with a long history of stability, and it can provide a hedge against the risks associated with holding large amounts of foreign currency. Now, there are a few different ways that banks can invest in gold. One option is to directly purchase physical gold, such as gold bars or coins. This allows banks to physically hold the gold in their possession and store it in secure facilities. Another option is to invest in gold mining companies, which allows banks to participate in the production of gold and potentially benefit from any increases in the price of the metal. Banks can also invest in gold through financial instruments, such as exchange-traded funds, ETFs, or futures contracts, which allow them to gain exposure to the gold market without physically holding the metal. In conclusion, there are several reasons why banks might choose to buy gold. It is a stable asset that can provide diversification, protection against inflation, and help maintain the value of foreign currency reserves. Whether you're a bank or an individual investor, gold can be an appealing option to consider as part of a well-rounded investment portfolio. It's important to keep in mind, however, that no investment is without risk, and it's important to carefully consider your own financial goals and risk tolerance before making any investment decisions. It's also worth noting that gold is just one of many different assets that banks and investors can consider as part of a diversified portfolio. Other options might include stocks, bonds, real estate, or alternative investments such as cryptocurrencies. Each asset class has its own unique risks and potential returns, and it's important to carefully assess the pros and cons of each option before making a decision. Ultimately, the decision to invest in gold, or any other asset, will depend on an individual's or a bank's specific financial goals and risk tolerance. It's important to do your own research, seek out professional advice if needed, and carefully consider all of your options before making any investment decisions. As with any investment, it's important to be aware of the potential risks involved in investing in gold. One risk to consider is the potential for price volatility. Gold prices can fluctuate significantly over time, depending on a variety of factors such as supply and demand, economic conditions, and geopolitical events. While gold has a long history of holding its value and serving as a hedge against inflation, it's important to be aware that there are no guarantees when it comes to the performance of any investment. Another risk to consider is the potential for fraud or scams. While there are many reputable dealers and brokers who sell gold, it's important to be aware that there are also individuals or companies who may try to take advantage of inexperienced investors. Be sure to do your own research and only invest in gold through reputable sources to minimize the risk of fraud. Finally, it's also worth noting that there are storage and insurance costs associated with owning physical gold. If you choose to invest in physical gold, you'll need to consider the cost of storing it in a secure facility and insuring it against loss or damage. These costs can add up over time and may impact the overall return on your investment. Despite these risks, gold can still be a valuable addition to a well-diversified investment portfolio. It can provide a stable, long-term store of value and serve as a hedge against inflation and economic uncertainty. However, it's important to carefully consider all of the risks and potential costs involved before making any investment decisions.